Welcome to Business Line Podcast. I'm Lokeshwari. The last few weeks have been quite action-packed with the union budget, the RBI monetary policy, the EU-India trade deal, and now the Indo-US trade deal. And the financial markets have turned quite volatile with all this news flow. Stock prices are in a tizzy, while bond yields are also beginning to strengthen quite a lot. To make sense of all this madness, we have with us today Devang Shah, Head Fixed Income, Access Mutual Fund. Hi Devang, welcome to the BL podcast.
Hi, thank you for having us.
So let's start with the monetary policy that just finished. So the
Definitely.
RBI has cut the policy rate by about 125 basis points between February and December last year. So now with the policy rate at about 5.25%, do you think that the current rate cycle has actually come to an end and there's going to be a long pause? Or are you in the camp that thinks that there could be some rate hikes also sometime in FY27 or so?
Right. So, first of all, you rightly summed it up. I think RBI has done a lot on monetary policy in the last 12 months, and they have been very, very supportive to the entire growth agenda, taking into consideration keeping an eye on inflation because inflation was significantly lower than all of our expectations, and including central bank expectation. RBI was very, very supportive for the growth side. Yes, cumulatively 125 basis of rate cuts. We also need to keep in mind that RBI has done more than 18 lakh crores of liquidity infusion in the last 12 months through various actions, OMOs, CRR cuts, FX buy sell, swap facility. Obviously, there has been some intervention on FX, there has been some leakage on account of which they had to do more. But 18 lakh crores is a big, big sum. Now, coming to your forward looking question on how do we look at rates and is RBI going to be on a long pause? My understanding is analyzing the macro environment today, and if I look through RBI's lens, RBI would focus on growth, inflation, and external sector. I think looking at the budget has been quite supportive for the growth side. They've continued with fiscal consolidation, but they're focused on both, which is like significant increase in spending on the capital side, which will lead to investments. And secondly, focused on some bit of increase in Manrega and other allocations. So when I look at the budget, I think it is very, very supportive for growth. And RBI need not be looking at giving any further monetary impulse. The second good news which we got in the last few days is about the trade deal with US, which has actually significantly reduced the trade tariff rate. We were all worried about that if tariff continues, the rate continues at 50%, we would see the probable growth environment to weaken and H2 growth for the calendar year 2026 can be a bit weaker. Now, with the trade deal certainty and at this point of time, the rate being competitive as compared to our Asian peers, I think that growth uncertainty, which was being penciled in, is now completely removed. So, with that context, we believe that growth can come above 7% for FY27 or 675 to 7% band. Secondly, you spoke about inflation. Yes, there can be an uptick in inflation in the second half of the year, but not immediate because of commodity prices going up, base metal specifically. I think aluminum, copper, steel prices have gone up massively in the last 3, 6 months, and which can lead to some bit of uptick in inflation. But at this point of time, when we look at the full year inflation, even the H2 inflation, it doesn't go above 475 as per me. And with that context, I think RBI can stay on a pause for most part of this year. If we see a bad monsoon or if we see a significant uptick in inflation, then probably RBI might look at some bit of rate increase in the second half of the year. But if you'll ask me, I will assign a very low probability to it. For most part of the year, I believe that RBI will be on a pause.
So you agree that the rate cut cycle has come to an end?
Yeah, as per me, I think the rate cut cycle has come to an end because what we believe is that the impulse which is required for growth is already being supported now with the trade deal and somewhere down the line a healthy budget. So I don't think so there is further monetary policy impulse required. And as we are all be talking about now that if H2 inflation, and there has been talk about the change in series of inflation also, which can lead to some bit of 15-20 basis of higher inflation. If the base year changes, inflation changes, we are looking at commodity prices, base effect works against us in this year. If H2 inflation is going to be higher, I would say that RBI being forward looking should be on a pause, and that is why, for me, the rate cycle is largely over.
Okay, so you did speak about the union budget that it set the right tone for growth, etc. So, what is your view on the gross market borrowing itself of about 17.2 lakh crore that was penciled in? I'd like your views on that. Does the market have the capability to absorb that kind of supply mainly? Yeah.
No, no, fair question. In fact, if you ask me from bond market perspective, we look at two or three aspects. Obviously, the quality of the budget. The budget is very, very credible. And let me again, if I outline the budget numbers, they seem to be a bit conservative. And on the tax revenues, on the nominal GDP, even disinvestment, I think can be sailed through if there are whatever has been spoken about. If the disinvestment targets can be also sailed through. So we find the budget to be very, very credible. Secondly, I think the bond market look at two aspects, which is the gross borrowing, net borrowing number, and the fiscal consolidation. They continue with fiscal consolidation, but it's a minor fiscal consolidation. We've all been talking about now that we are largely like rate cycle is over, even the fiscal consolidation is largely over because we have been one of the economies who have been doing massive fiscal consolidation over last so many years. At 4.3 and a glide path to centers debt to GDP going across to 54, 50, sorry, 55, around 55%, I think the numbers looks okay to us. Now coming to the specific challenges, which is the gross borrowing and net borrowing. If you'll ask me, net borrowing is okay. Gross borrowing on 17.25 lakh crores seems to be slightly higher. Our estimates were close to 16.5, 16.75 lakh crores. So a 75,000 crores higher than market expectation and even my expectations. Now, how is the demand supply dynamics looking at into the year going ahead? We believe that we were slightly positive on two fronts that which would help to bridge the gap on the demand supply dynamics. One was our bonds getting added in Bloomberg, global aggregator index, which could have fetched us some 20-25 billion of flows. I think there is still a very high probability we get added, but it might be now shifted. The flows might get shifted to the second half of the year or probably next year. So that would have bridged the gap of 2.5 lakh crores. Otherwise, we believe that with the 17.5 lakh crores of gross borrowing, there is a demand supply gap of close to 2.5 lakh crore, assuming 4 to 5 lakh crore of OMO next year. With that assumption, also we see a 2 lakh crores of gap, and that is why our assessment is that unless we see the Bloomberg flows coming in, probably there can be some impact of this large borrowing on 10-year bond deals, specifically the government bonds.
Okay, so were you disappointed that the RBI did not really spell out the quantum of open market operations in this monetary policy? Would that have actually helped reduce the volatility in the yields?
See, I think broadly market was expecting nothing in this policy. I think a large part of the market was of the view that RBI can stay put because they've done a lot. And though they have not announced anything in the policy, they've done a lot of liquidity measures after the last December policy also. So in the interim, Jan and Feb, they were very vigilant. They were continuously monitoring the liquidity, and they have done a lot of liquidity measures. So they did 2 lakh crores of OMOs. They done 1.5 lakh crores of, sorry, 3 lakh crores of OMOs and 1.5 lakh crores of FX buy sell. So if you'll ask me personally, I don't think that a lot of market guys or even we were not expecting any kind of liquidity measures into this monetary policy. I thought if they wanted to do, they could have just done something to address the frictional banking liquidity, because large part of the durable liquidity which RBI is creating is sitting with government. So I'll explain the math. Generally, the durable liquidity which gets created into a system is either sitting with banks or with government. For some reasons, at this point of time, the liquidity RBI is being very vigilant and creating that liquidity, but the liquidity is sitting with government, because of which we are seeing some kind of pressure at the short end of the curve, where CD rates shot up, the short end of the curve shot up, and government bonds also give up the rally. So our assessment is that yes, liquidity seems comfortable, and that is why RBI could have passed or not done anything in the monetary policy. What I was talking about, the demand supply gap, is for the next year, and where they need to actively engage with the market and continue to do open market operations so that they can sail through the large borrowing. Current volatility in bond deals is on account of two or three reasons, as per me. I think if I look at the last 2 months, bond market yields have gone up across the curve. Like the short end of the curve has gone up by 50-60 basis. Corporate bonds 3 years are around 40-50 basis up. 10-year GSEC is 25-30 basis up. There have been, I would, if I chalk out, there are two or three reasons. One, there's been a large unwind of, I would say, positions from FPI investors. They started thinking that probably we are at the fag end of the rate cycle, and rate cycle is largely done. So they're just cutting risk on India, which leads to a sell-off on bond yields or rise in bond yields. The second thing has been that somewhere down the line, the huge SDR supply, which is 5 lakh crore announced in the Q4, which probably led to all the concerns and worries on bond market yields, because such a huge supply will probably put a lot of pressure on long bonds. And thirdly is this huge strong credit growth in the banking side, which has led to rush or demand for deposits. And at the same point of time, because this frictional liquidity has got a bit tightened, where money is sitting with government, I think it has led to the sell-off in the short end of the curve. So you've had all the reasons coming together, where you had a decent part of FI cutting risk on India or long positions on India. Secondly, you've had this entire huge SDL supply. And thirdly, a strong credit growth altogether has led to the volatility in our bond market yields.
How do you, what is the range that you kind of see the 10-year bond yield moving maybe in the next year or so?
So I would say what we believe is that Jan to March 2026, we can see the yields in the 660, 680 band. But if there is no respite and there is no action, specifically, as I told you, there's a lot of expectation of OMOs next year also. If RBI disappoints a bit also, or the OMOs come mostly in the second half of the year, then we might see April onwards yields inching up, and we can see it in the 680 to 7% band. So I would say for the full year, the band can be 675 to 7 for most part of this year in FY 2027.
So what's your view on the global bond yields itself? We see in the US especially the yields are hardening. So does that also have an effect on our domestic yields? Uh,
Yeah, so see, I would say that definitely any kind of larger global reversal in yields does have some bit of impact on Indian bond markets also, but they're now not so massively correlated as it was before. We have time and again explained to our investors through various communication that the correlation is to a large extent broken between US bond yields and Indian bond yields. If you look at it from 2022 till now, like let's talk about the entire rate hike environment and then the rate cut. We had seen the 2022 US treasuries were closer to 2%. Today they are at 4 quarter. At the same point of time, Indian 10-year in 2022 was 7.5. Today it is 6.75. So despite all of the rate hikes, despite all of the noise and concerns on US treasuries, our bond markets have actually rallied. I'm looking point to point. It's been 4 years. So the message which I would like to tell investors is that obviously the global rate cycle does have some bit of impact on the way forward for bond markets. That if global central bankers are not cutting, even RBI will think that, okay, how is the local trajectory on inflation? Is there any dire need for growth? So it probably puts across some kind of data points for RBI. But is there a massive correlation where US Treasuries sell off or there's a significant rise in yields and Indian bonds also will see a significant rise in yields? My view is no. Now, coming to a specific question, how do we look at Fed rate cuts and bond yields globally? I think even global central bankers now would be on a pause because they have done a lot of competitive and rate easing over the last 12, 18 months. And hence, we believe that large part of the rate cycle, even from Fed, is largely behind us. Can they cut couple of times in this year? Probably yes. So 25, 50 basis rate cut is possible, but I would not attribute a significant rate movement even in Fed US rate Fed rate, as well as that having an impact on Indian bond yields.
how is the spread now between India and US? The real spread that people usually watch. So how is it now? Is it still comfortable and yeah?
Yeah, so see, how does the spread get determined? We also need to look across at the inflation cycle in both the economies, because what was the spread was somewhere down the line the difference in the real rates between the two economies and the difference in the inflation. If you look at the inflation, US inflation is hovering around 2.5 to 3%, and US 10-year is at closer to around 4 quarter, just for simplicity purpose. So 275 and 4 quarter, 4.25. The differential between inflation out there and the 10-year is around 175 basis. Let's look at US inflation and India inflation gap. India inflation for the year has been average around 275, similar to US. Like that's never happened for so many years, right? So we are in a cycle where our inflation is similar to US. But let's not look at this year's inflation because there were a lot of one-offs. We had a massive food inflation, disinflation. We had a massive oil disinflation, which helped India CPI basket. Let's look at the next year forward-looking inflation. US is at 3, India is at 4%. So the gap in inflation between the two economies is closer to what, 1.5% at max. Now let's look at the bond yields. US 10-year today is at 4.25, 4.15 when as we are talking, but largely around 4 quarter band. India 10-year is close to 675. So actually the gap between the two markets is close to 250 odd basis. Is this good enough in a year where inflation gap between the two economies is less than 2%? I think completely, I would say that we don't expect the spread to widen. So currently the spread between the two economies, US 10-year and India 10-year is 250 basis. And when I compare it with the inflation gap, which is 1 year hence also if India inflation settles at 4.5 and US at 3, the inflation gap is only 150 basis. So in that context, we believe that the spread is quite okay and we don't see the spread to widen.
So, what about the rupee? What is your view on that? Now, with the rupee stabilizing, does that also give some comfort to the bond market?
Definitely. And I would say that the bigger overhang was currency to a certain extent because what was happening is that people are getting worried about the tariff deal or the trade deal not coming through. And there was a continuous vulnerability on the currency side. Obviously, a significant depreciation on currency can also be a problem for bond markets because people look at it as inflationary. So, with some bit of comfort on the trade deal, I think the rupee vulnerability significantly reduces, and we believe that rupee should stabilize around 1992 band for most part of this year, or 89.91 band for most part of this year. I don't significantly see an appreciation in rupee because we believe that RBI has also had a short forward book, which is significantly large, and any kind of massive flows or would be sterilized by RBI to knock off the short dollar book, and hence we believe that rupee would probably trade in a range, an 88.91 for a wide range or 89.91 for a narrower range. We are not an expert on currency, but looking at the macro environment, we believe that this is where rupee should stabilize for the year. Impact of that on bond markets should be mild positive. I think on an overall perspective, it can lead to RBI remaining on a pause for longer point of time.
So, the final question, so what for the fixed income investors, for the investors, and what kind of strategy are debt fund managers likely to pursue? What would you be pursuing in this kind of a scenario?
Sure. See, I think bond markets always work with the overall top-down approach on macro and analyze all of these variables as we highlighted, which is growth, inflation, external sector, and many other variables are taken into account while deciding what the strategies make sense for clients. I think the 2024 was a year for duration. 2025 was a year of liquidity, which led to steepness in the curve, where we saw the short end of the curve massively outperforming the long bonds. Like in 2024, duration, absolute duration played very, very well. Long bonds played or gave the highest return. In 2026, we believe that because RBI will be on most part of the year, RBI will be on a pause, or we might start getting worried about inflation and the reversal of the interest rate cycle. There is a very high possibility or to stick around on the short end of the curve. So what we advise clients at this point of time is to buy short end of the curve, buy 1 2 year AAA corporate bonds which are significantly available at higher yields. So which we believe makes a lot of sense for clients at this point of time on the basis of our macro environment, where we don't expect any kind of rate action from RBI for most part of the year. So short end of the curve, accrual is a strategy, is what we're advising clients. And if some investors want to take some tactical bets, I think what the other part of the curve which we like is there's a significant rise in spreads for state development loans or state government securities, where they have significantly sold off. So how does a retail investor can look at these strategies is by investing in gilt funds who have a higher allocation towards state government securities. There, the spreads have significantly widened because of the high supply, which I just highlighted. So, from a bond market perspective, we advise to stay put or to stay invested in the very, very short end of the curve, up to 1 to 2 year duration, and largely weather through this volatility in bond markets over the next 6 to 12 months. And a part of the investment can happen through tactical bets in gilt funds having a higher allocation towards state government securities. From fund strategies, I would say that investors should always focus on three aspects or two aspects. One is his investment horizon and his risk return analysis. If an investor is looking for shorter term investment horizons, like looking for 3 6 months investment horizon, I think he should always target parking solutions like money market strategies. If an investor on fixed income is more a medium term investor looking for at least up to 2 year of investment horizon, there's a very, very good category which is income plus arbitrage fund of fund category, which is a blend of debt funds and arbitrage funds in the ratio of 65-35, which if you stay invested for 2 years, gives you a taxation benefit similar to an equity fund. And that is why we believe it makes a lot of sense for investors who are medium term debt investors. And the third is for investors who are looking at tactical opportunities. I think gilt fund makes a lot of sense with higher allocation at this point of time to state government security. So these are the three categories, which is parking solutions is money market category. The medium term debt investor who is very conservative is looking at good tax efficient solutions, income plus arbitrage fund of fund category. And the third one is who's looking at more tactical opportunities in bond markets. I think gilt funds with higher allocation towards state government securities.
Okay. Thank you so much, Devang, for taking your time out and answering all our questions.
It's always a pleasure. Thank you for having us.
Thank you. Bye.